Welcome back, everyone. We are jumping right into something highly specific today, and I really need you to listen closely. Unlike the usual topics we discuss here, the details I am sharing today come with strict expiration dates. Right now, there are legal benefits and financial programs available to older adults that can put hundreds or even thousands of dollars back into your bank account. But here is the catch. They are completely useless if you miss the deadline. If that window closes, your money vanishes. It isn't delayed, and you cannot get it back later. It is just gone for the rest of the year. I have taken the time to research the current cutoffs, the dollar amounts, and the exact steps you need to take. So, grab a pen and paper. We are going to break it all down. But before we dive in, please hit that subscribe button and turn on notifications. I share these kinds of alerts because the government will not give you a heads up when these deadlines approach. No official is going to call your house or mail you a friendly reminder. Every single year, untold numbers of seniors lose out on these benefits. They do not miss out because they are ineligible. They lose out because nobody bothered to tell them the deadline was coming. Helping you avoid that is exactly why this channel exists. So subscribe and make sure to follow our Facebook page. You will find the link down in the description. We share regular tips and vital alerts over there between our video uploads too. All right, let us get started. We are going to begin with the most pressing item, which also happens to offer the biggest financial return: property tax exemptions. If you are 65 or older and own your house, your state almost certainly has a program designed to lower, freeze, or heavily reduce your annual property tax burden. And we are not talking about pennies here. Depending on where you live and what your house is worth, these waivers can save older homeowners anywhere from $1,200 to $6,500 every single year. If you look at a typical 20-year retirement, that equals between $24,000 and $130,000 staying in your pocket rather than going to the county. Now, here is the crucial detail that most financial guides completely ignore. These savings do not kick in on their own. There is not a single state in America that magically lowers your tax bill the moment you turn 65. You are required to submit an application yourself. Furthermore, every state sets its own cutoff date, usually linked to their local tax assessment schedule. If you miss that date, you have to wait a full year to try again. Let us look at where things stand right now in early June 2026. A few major deadlines have already come and gone this year. Florida closed its window on March 1st. California ended on February 10th, and Texas wrapped up on April 30th. If you live in one of those areas and missed it, your next shot is next year. However, right now is the time to gather your paperwork, not next January. But do not worry, because several major states still have open windows. In Pennsylvania, the property tax rebate deadline is June 30th, 2026, just weeks away. Unmarried residents there making under $35,000 or married couples making under $45,000 could see a rebate of up to $1,000. Colorado keeps its doors open until July 15th, and New Hampshire runs until June 30th. In Illinois, they recently increased the income limit for the Senior Freeze program for the 2026 assessment year. This means folks who made too much money in the past might suddenly qualify, and they are accepting those applications right now. Beyond the state dates, there is a massive trap that catches many people off guard, especially if you still have a mortgage. If your property taxes are paid through an escrow account set up by your mortgage lender, meaning the bank takes the money out of your monthly payment, getting approved for a tax break does not automatically lower your mortgage bill. The bank might keep charging you the higher, older rate for months. The second you get your approval letter, send a copy straight to your mortgage servicer and demand an escrow review. If you do not take this step, you will keep overpaying every month waiting for an adjustment that nobody is going to make for you. So, what is your next move? Head over to your county assessor's website. Search for your county's name along with the phrase, Senior Property Tax Exemption 2026 to find your local application and cutoff date. If you already signed up in the past, verify if your state demands a yearly renewal. Lots of income-tested programs require this, and forgetting to renew is the second most common reason people lose this benefit. Also, if you were rejected before, double-check the new income ceilings. Illinois bumped its freeze limit up to $65,000. New Jersey's Stay NJ program now covers incomes up to $150,000, and New York's Enhanced Star program reaches $98,700. You might be eligible today, even if you were blocked last year. Just one final note regarding your property taxes. Many regions let you stack different benefits together. You might be able to put a senior exemption over a standard homestead exemption, and then layer a senior freeze on top of both. Texas lets you combine a homestead break, an over 65 break, and a school tax freeze all at once. Illinois lets you stack the general homestead, the senior citizen exemption, and the senior freeze. When you merge all these available programs together, your savings can easily reach several $1,000s annually. Sadly, most older adults just use one, if they use any at all. Call your county assessor to see if additional programs apply to your specific situation. Next up, let us move on to a benefit that does not have a strict calendar deadline like property taxes, but it absolutely drains your wallet every single month you delay. It is called Extra Help, which is officially known as the Low Income Subsidy. This federal program steps in to take care of most, or sometimes all, of your Medicare Part D prescription drug expenses. Let us look at what this actually means for your wallet. Without Extra Help, you are stuck paying a monthly premium for Part D, a yearly deductible, and a chunk of the bill for every single medication you fill. That easily adds up to hundreds of dollars a month if you take several prescriptions. But if you get Extra Help, your monthly premium disappears, your deductible drops straight to zero, and the most you will ever pay out of pocket for a covered medication is capped at $5.10 for generics and $12.65 for brand name options. Period. That is your absolute maximum, regardless of the retail cost of the medicine. To qualify in 2026, your yearly income needs to be below $23,340 for a single person, or under $31,860 for a married couple. If your income falls below those lines and your savings are modest, there is a massive chance you are eligible, but simply haven't signed up yet. In fact, official data reveals that roughly 2.2 million Americans who qualify for Extra Help are not enrolled. That means millions of people are overpaying by hundreds of dollars every month for essential medicine. Now, there is no special sign-up window for this. You can apply whenever you want. But here is why you need to act right now. Every month you wait is money out of your pocket that you can never get back. If you qualify right now, but wait until autumn to apply, the government does not refund you for the months you missed. Those savings are gone forever. Signing up today means your relief starts next month. To apply, just visit SSA.gov, call Social Security at 1-800-77-21213, or drop by your local office. The application takes roughly half an hour, and you usually get an answer in a few weeks. Quick tip: if you are already in a Medicare savings program to cover your Part B premiums, you are automatically signed up for Extra Help and do not need to do a thing. Call 1-800-MEDICARE if you are unsure. Our third topic is specifically for anyone who sent in their 2025 federal tax return recently. If you are 65 or older and missed the new $6,000 senior tax deduction introduced by the One Big Beautiful Bill Act last July, you likely sent Uncle Sam too much money. Fortunately, there is a very straightforward way to get it back. Here is how this new deduction works. Starting with the 2025 tax year, any American aged 65 or older can shave an extra $6,000 off their taxable income. This is completely separate from, and in addition to, the standard deduction and the older senior add-on. If you are a married couple, and both of you are 65 or up, that gives you a massive $12,000 extra deduction. To qualify, your modified adjusted gross income has to be under $75,000 for single filers or under $150,000 for married couples. This is a huge deal for your Social Security because depending on your total income, the government can tax up to 85% of your benefits. This $6,000 deduction lowers your taxable income so much that many seniors will see their tax bill plummet, and some won't owe a single dime on their Social Security income. The IRS takes this deduction on a new form called Schedule 1A, which came out in April 2026, and all the big tax software programs have it ready. Now, since the filing deadline has passed, most of you have already submitted your taxes. If you filed without this because you had no idea it existed or your software didn't mention it, you overpaid. For someone in the 22% tax bracket, a $6,000 deduction saves you $1,320 in cash. Even in the 12% bracket, it puts $720 back in your pocket. To fix this, you just need to file an amended return using Form 1040-X. You do not redo your whole tax return, you just fix the specific lines that changed. The IRS allows you to file this electronically for the 2025 tax year, which makes things move much quicker. While standard processing can take up to 16 weeks, many people get their refunds much faster. You technically have 3 years to do this, but why let the government hold on to your cash? Pull out your 2025 tax paperwork, look for Schedule 1A, and see if that senior deduction is there. If it is missing, file that amendment. Any tax software or professional can walk you through it easily. Just keep in mind that the income phase-out starts at $75,000 for singles. For every $1,000 you make over that limit, the deduction drops by 6%, vanishing completely once you hit $100,000. So verify your adjusted gross income first. Let us move on to the fourth item. This one does not have a strict calendar cutoff like the others, but timing is still incredibly important because a massive amount of cash is on the line and resolving the issue takes time. I am talking about your official Social Security earnings history. This record dictates the exact size of your monthly retirement check, and there is a specific window to fix mistakes that might have been shrinking your payments for years. The government calculates your retirement benefit based on your 35 highest earning years. This data relies entirely on the payroll details your past employers sent in over your career. If an employer made a typo, forgot a year completely, or messed up your self-employment records, your monthly check is going to be smaller than it should be. According to Social Security's own statistics, just 1 year of incorrect earnings records typically cuts your monthly check by around $100. That means you lose $1,200 a year, $12,000 over a decade, or a staggering $24,000 over a 20-year retirement, all from a single mistake. You can locate and repair these errors right now by viewing your online statement at SSA.gov through your personal account. Take a close look at the income listed for every single year you worked and double-check it against your old W-2 forms, tax papers, or pay stubs. If you spot an error, submit an official request to correct your earnings record along with your proof. They will review it, fix the mistake, and update your benefit amount for the future, and sometimes even pay you retroactively. The reason you want to do this immediately is paperwork. The older a mistake is, the tougher it becomes to track down the proof. Finding a W-2 from 25 years ago is much harder than finding a recent one, and old employers might be completely out of business. Social Security can pull old tax records all the way back to 1978 for free to help you fix this, but that depends heavily on whether the IRS records are still accessible. Checking today, while your own documents are handy and the history is fresher, gives you the absolute best shot at fixing these blunders before they permanently lower your retirement income. So, let us recap the whole picture. For property tax breaks, deadlines are state-specific. Several are still open right now, like Pennsylvania on June 30th and Colorado on July 15th, with others running through the summer months. If your state closed its window, use this time to prepare for next year and see if higher income limits mean you now qualify. For extra help with prescriptions, over 2 million eligible folks are missing out. There is no enrollment window, and every month you stall is money wasted. Sign up at SSA.gov or call 1-800-772-1213. Regarding the $6,000 senior tax break, if you filed last month without it, you overpaid your federal taxes. File Form 1040-X to claim your money back. And finally, log into SSA.gov to review your earnings history and correct any mistakes. The government is never going to send you a warning when these deadlines pop up. They will not call you to say you overpaid your taxes, and they will not reach out to tell you that you are missing out on prescription assistance. Staying informed means staying connected to the places that track these details. Hit subscribe on this channel right now, follow us on Facebook using the link below, and pass this video along to someone who might be leaving their hard-earned cash on the table. I will catch you in the next one.